two things I would say to any new traders out there and looking what I went through is one, educate yourself, but just make sure you understand who you're following and what you're following.
Be a teenager, a millennial, or literally anyone who's investing in the stock market needs to be up to date with what's happening around. This is especially necessary when trying to follow growth stocks, as they are considerably more volatile in exchange for high returns. The AMC stock has proven to be a strong contender in this category in the last few days. But is it really the stock you should risk your money with? Stay tuned till the very end as we cover top 3 growth stocks that could give you a better bang for the buck. What are growth stocks? Investing in the stock market isn't completely different than traditional investment plans, but certainly has an added risk factor in exchange for much higher returns. When stock prices are growing in general, growth stocks tend to outperform the market. They're more volatile compared to the value stocks, and the capital gains provide a significant amount of revenue. Growth stocks often pay either minimal or no dividends, and they typically have a strategic edge over other firms in the same sector, as well as a devoted and expanding customer base. The edge or a competitive advantage could be anything from a patent or a new product. To give you an idea, stocks like Netflix, Amazon, or even Apple can be considered as examples of growth stocks. But who should likely invest in them? A fairly young trader with a longer time horizon and a greater risk tolerance will be well to gain from a growth stock heavy portfolio. Investors capable and ready to contribute a percentage of their portfolio for the long term feel growth investing is a strong instrument. AMC stock, what's all the fuss about? AMC Entertainment Holdings Incorporated is the largest movie theater chain in the world. After enjoying its golden years till about 5 years ago, the company was on the verge of going bankrupt recently. AMC spent over $120 million each month in the first quarter, which ended on March 31st. The coronavirus pandemic had caused chaos in its operations, requiring it to lock its doors to audiences and waste hundreds of millions of dollars in potential income while still maintaining its buildings and paying its employees. So, how did AMC finish the first quarter with the highest quarterly profitability in the company's 101-year history? Retail investors are the answer. AMC Entertainment Holdings, which has gained more than 3,000% since the beginning of 2021, is by far the best performing stock in the market. Professional short sellers betting against AMC were targeted by a group of Reddit retail investors. AMC launched an effort termed AMC Investor Connect at about the same time to reach out to its early investors. AMC theater guests were also given complimentary popcorn. Over the last several months, the company's retail shareholder base has surpassed 3 million. AMC intends to express its thankfulness and interact with its extraordinary base of enthusiastic and passionate individual shareholders through this Investor Connect initiative, according to the firm, with the CEO Adam Aron announcing free popcorn when attending the first movie in the summer. Spurred by the promise of free popcorn, with doubling the share price in a single day demonstrated a significant divergence between price and underlying value. AMC had announced a $230 million raise the day before by selling 8.5 million shares to Mudrick Capital Management, later raising the number by another 11.5 million shares. A share sale usually lowers the stock price in the near term since it reduces the number of outstanding shares. As investors applauded the capital increase, AMC stock continued to move in the green. The rise was unaffected by the selling of shares. The world's largest movie theater network is so large that retail investors from India and South Africa couldn't help but want a slice of the pie, with AMC enjoying a great deal of attention, even more than the likes of Facebook and Tesla. The driving forces behind such huge investments mainly were, as more people are getting vaccinated, states are lifting restrictions and major studios are resuming theatrical releases, with many people being optimistic about venturing back to theaters. Other than that, over the previous months, short sellers have raised their bets on AMC shares, basically stubborn millennials trying to prove their point. The surge of moviegoers will boost entrance income as well as the extremely profitable concession sales, restoring company to pre-COVID-19 levels. Such volatile conditions have caused the AMC stock to detach itself from the fundamentals. But don't forget, we have a name for this too: meme stocks. A meme stock is one that has witnessed a spike in volume due to exaggerated buzz on social media and online forums like Reddit, rather than the company's performance. Meme stock valuations are unrelated to fundamentals and reflect social media excitement. These stocks rise as long as they receive attention, else they will collapse. The hype surrounding the AMC stock, with people managed to outlast the short sellers, but various exchanges and even AMC Entertainment themselves have issued warnings asking people to be cautious. This was all about AMC stock. It's still enjoying a good seat in the market, but is it worth your money now? The truth is that AMC was already in trouble prior to the coronavirus pandemic. It's not simply an issue for the theater owners, it's an ailment that affects the whole business. Theatrical sales peaked at 1.57 billion in 2002 and have since gradually declined. In order to survive the COVID pandemic, AMC had to take a substantial credit. It had $5.4 billion in long-term debt, $1.6 billion in current liabilities, and $4.9 billion in operating lease expenditures at the end of the most recent quarter, with $800 million due this year and another $1 billion due next year. While it raised more than $1 billion this year, it lost $567 million. Thus, AMC Entertainment is not the best places to put your money if you want to make a long-term investment. Finally, where do you invest then? So, coming up are top 3 growth stocks to invest in. Number 3, Amazon. For long-term investors, Amazon is one of my favorite growth stocks of all time. Shares of the firm are up more than 730% from where they were a year ago, and experts believe the company still has lots of room for growth. They set a high price objective of $5,500 per share for Amazon, implying a potential upside of approximately 60% from the stock's current price. In 2020, the firm recorded a 38% increase in net sales and a roughly 84% increase in net profits. Amazon's net sales climbed 44% year over year in the first quarter of this year, and whose bottom line increased by more than 220%. Amazon's wide range of profitable companies makes it a great recession-resistant option to add to your basket if you're looking for a company that will help your portfolio through whatever stormy market waters may lie ahead. Number 2, Bed Bath & Beyond. Bed Bath & Beyond's capacity to create huge amounts of cash was one of the distinguishing characteristics. It used to generate more than $1 billion in free cash flow on a monthly basis, and it was still producing $750 million shortly before the epidemic. The company was then compelled to lose its outlets, throwing the economy into disarray. Even as it emerges from the rubble, Bed Bath & Beyond revealed that it was already profitable with $62 million in FCF last quarter. In the next quarters, expect this to increase. It has put a lot of money into its e-commerce platform and supply chain, and the new emphasis should help it reclaim its dominance in the home goods market. Number 1, GameStop. GameStop may seem a surprising choice as the original meme stock investment, but that's where patience and waiting for the mob to move on may pay off. GameStop has a turnaround investment quality that should result in substantial gains. The new management team, which is almost entirely made up of Amazon and Google employees, aims to transform the video game retailer into a consumer-focused, online-oriented gaming firm. Chairman Ryan Cohen intends to make it the Amazon of gaming. It's beginning from a strong position, having raised additional cash using the meme stock trading craze that increased its share price, paid off its debts completely. GameStop is without a doubt the riskiest of the 3 since it's betting on virtually untested transformation. However, the epidemic resulted in a surge in traffic to GameStop's e-commerce site, indicating that the retailer's well-known brand may serve as a beacon for customers looking for gaming media, technology, ratings, and more. Rather than relying on AMC's struggling company and sector, GameStop is a stock that might pay off handsomely if you wait for it to trade at a low price. These are my picks. Stocks that I would certainly be following and perhaps investing in. AMC stock was certainly a phenomenon, but it isn't where I would be putting my money right now. Tell me your views and picks in the comments below, and don't forget to like, share and subscribe for more such investment videos.